Hello, and thank you for joining us today for our webinar, the 2024 Commercial Real Estate Insights for Region 5 with Brian Bailey, CCIM. Brian's from the Federal Reserve Bank of Atlanta. Before we get started today, we'd like to take a moment to thank and recognize our sponsors from all the chapters in these regions. If you look on your screen, you can see the chapter sponsors. We really appreciate them and all they've done with us for these exceptional events. We'll begin the presentation here in a few moments with Brian. Okay, thanks again for all of our chapter sponsors. Again, our webinar today is a 2024 Commercial Real Estate Insights for Region 5 with Brian Bailey. Again, Brian is with the Federal Reserve Bank of Atlanta. We'll look forward to starting here in a moment. And my name is Ferd Neiman. I'm an attorney at KC Real Estate Law here in Kansas City, also on the board of the local Kansas City chapter. I also own and operate mobile home parks in the Midwest. Today, we're going to have, again, great presentation from Brian. I'm going to hand this over to him in a second. Happy to be here with you. We'll go for about 45 minutes, and then we will have Q&A. Again, you can ask questions through using the Q&A tab, which is in the chat function. I'll be watching those, and we'll answer questions at the end. So again, about 45 minutes followed by 15 minutes of Q&A. And today, Brian will be talking about leveraging key figures such as inflation, Federal Reserve policy, housing data, insurance, et cetera, which will help you understand where the economy is and where the commercial real estate markets may be headed this year. Again, feel free to ask questions via the chat function, and we will go from there.
Great. Thank you, Ferd. Can you see my screen all right?
Yes.
Great. Wonderful. Thank you all for joining us. I appreciate the investment of an hour out of your day. I'm greatly honored to share a few thoughts on commercial real estate. I'm a subject matter expert at the Fed, and today the title of the presentation is 2024 Commercial Real Estate, Turbulence Ahead. And with that, just to be clear, these are my views and not necessarily those of my colleagues at the Federal Reserve Bank or the Board of Governors. A little bit about me, just to give you context on my thoughts. So I've been at the Atlanta Fed for roughly 12 years. I'm the Fed's subject matter expert in commercial real estate. Prior to that, I spent 15 years of the private side of the business. I worked for a very, very large family office doing real estate acquisitions and finance for them. Prior to that, I ran real estate finance at Flagler Development, which was Florida's largest commercial developer prior to being bought out. Prior to that, I spent a number of years, was an executive at the Big Four accounting firm Ernst & Young, doing real estate work for their clients. And then I, prior to that, founded a small industrial development company. So I have had a wide range of experience across commercial real estate, and that's helped me here at the Fed. So let's talk about kind of the national economic climate. So what we have, this is unemployment rates. You may have seen this a time or two, but in essence, U3 in green is the most widely quoted number in the press as far as unemployment is concerned. Right now, about 3.9%. It's ticked up just a few basis points from 3.4%. It's all-time low. From that standpoint, the policymakers have been articulating that we're coming off, but still remain very close to roughly 50-year lows as far as unemployment rates are concerned. If we look at a broader definition of unemployment, U6, and U6 includes folks who have given up, who have multiple part-time jobs, who want a full-time job. In essence, right now, that rate is 7.4%. However, down, compared to history, it's down significantly from roughly 17% at the height of the GFC, the Great Financial Crisis, down from almost 24% in May of 2020, right after the pandemic hit. So from that standpoint, we are at very strong, very low unemployment rates, which is a good omen, good driver for commercial real estate. On top of that, in orange, you'll see the labor force participation rate. And right now it stands at 62.7%. Obviously, it's ticking up a little bit. And from that standpoint, my view is that people are returning to the workforce who have been impacted by inflation. You think about retirees and those folks who are on fixed income. From that standpoint, we are seeing more of them impacted by inflation, and hence they're returning to the workforce. Good news again, in that job creation by month for the national economy continues to remain robust. I'm in the group that the economy needs to create roughly 100,000 jobs a month to keep up with natural population growth. As you can see, the economy is creating well in excess of that, even with the April jobs number at 175,000, which was a bit of a disappointment for the industry. But you can see that in 2024 and 2023, the economy is creating, on average, roughly 250,000 jobs a month. 2022, it was 377, and in 2021, because of the impacts of COVID, return to work, we created over 600,000 jobs a month on average. State of unemployment, I wanted to kind of paint a very broad picture here, but in essence, you can see Region 5 has some of the lowest state unemployment rates across the nation. Nebraska, Kansas, Iowa, Minnesota, and the Dakotas all have a sub 3% unemployment rate, which is very good. You look at states in the Southeast, just a notch above that, and then certainly our neighbors to the west, California, Oregon, Washington, all have rates high, fours and above. So from that standpoint, good dynamics across Region 5. If we look at consumer sentiment and why do we monitor the consumer? Well, in essence, consumer drives about 68% of the overall economy. So certainly gauging their sentiment is very important. And as you can see, that sentiment is slipping a bit. From that standpoint, we know that the consumer has been impacted by inflation. And from that standpoint, that is impacting their sentiment, which we need to continue to watch. If we look at county growth across Region 5 plus the neighboring states, we can see a mixed bag. South Dakota, Minnesota doing well. On the other hand, Iowa, Nebraska, Kansas, and North Dakota, areas in kind of that orange or red, have actually seen a year-over-year decline in job growth. So a mixed bag across Region 5 plus some of the neighbors. If we look at the Philly Fed's coincident index, we see nationally that growth continues. And we see some of the states that I just called out for having negative job growth actually having positive results. And let me kind of clarify that. So the Philly Fed's coincident index includes the change in employment. It includes a change in hours for work, pardon me. It includes changes in labor rates, and some metrics there. So in essence, we saw on the previous slide where job growth was down, but in essence, those folks may be working more hours. They may be being paid more. And this index picks that up. You can see Region 5, among the stronger areas of the country. So from that standpoint, all except North Dakota are having positive dynamics on that front. This represents consumer loan delinquencies, and you can see that some of the neighbors in the South right now may be getting ahead of their skis a little bit. This includes credit card debt. It includes autos, basically any type of consumer debt except first mortgages. And you can see, the Sun Belt is seeing, a pickup in delinquency rates back to Region 5. The Dakotas, Nebraska, Minnesota, Iowa, continue to look on solid footing. The consumers look on solid footing there, not having the significant increase in delinquencies that you're seeing in the likes of Texas or the lower Mississippi Valley, i.e. Mississippi, Louisiana, Arkansas, etc. Obviously, CPI, Consumer Price Index, is a very a very closely watched gauge these days. And so this is a heat map of the various components, and it represents year over year growth by month. So in essence, you can see that 2022 in red, most of it was in red, which in essence is indicating very, very strong, robust growth. However, the headline number is tapering into 2023. And then, we begin to see, the likes of energy prices declining. That is represented in blue. And from that standpoint, we see some more blue in 2023. And then going into 2024, we begin to see some of that blue taper off. In essence, the declines in CPI tapering off and beginning to return to a little bit more, a growing number. And so on that front, certainly the market has not expected that. And from that standpoint, certainly that is been apparent in the changes in Fed policy, as a number of policymakers at the beginning of the year had roughly 3 cuts in their projections, and certainly those have been ratcheted back pretty significantly over the last couple of months. From that standpoint, it's a number that we continue to track very, very closely. Areas, we look at the tie to commercial real estate. So you look at housing, whether it's shelter, the rent of primary residence, lodging away from home, or owner's equivalent rent. We see all of those areas, continuing to run a bit hot. And from that standpoint, we know they lag, but in essence, we will continue to watch and watch very closely as they have a sizable impact on CPI. Good news, bad news. I kind of tease my children who are college age right now that they don't even have to get out of their car to, in essence, know what inflation is doing. This represents basically the correlation between CPI in blue and retail gas prices in orange. And so from that standpoint, there is a very, very strong correlation between gas prices and CPI. And what we know is that while it fluctuates pretty widely, it has fluctuated pretty widely over the last couple of years, we know recently there's been a pretty sizable uptick in the average price of gasoline. And so on that front, I think we'll have to continue to watch as inflation may continue to run stronger, hotter than normal. which will have implications for policy. Talk a little bit more about commercial real estate. Feel free to put your questions in the chat. I've taken a national view of office vacancy because I think that there's a real story here. If we look at some of the markets with the highest vacancy rates, in essence, those markets tend to correlate to the largest US office markets, i.e., New York, Chicago, Atlanta, Dallas, LA, San Francisco, and Minneapolis. So what we know is that the dynamic that we're facing right now is one driven by density, higher density areas from that standpoint continue to be impacted greatly by work from home. They're also impacted because as tenants using office space have begun to look at not only work from home, but they're also looking at the percent of folks who travel. And from that standpoint, our larger cities have a higher percent of folks who travel. It is also easier to consolidate space with those larger tenants. If you think about, it's easier for a tenant who has 10 stories of an office building to consolidate to 8 versus a smaller tenant with 3,000 or 4,000 feet trying to cut anywhere from 600 to 800 square feet, similar proportion. So a much different dynamic there. If we look at office vacancy rates across Region 5 with the neighbors, you in essence see, there are some areas that have seen, sizable change in the last year. Again, some of those larger markets, Denver, Minneapolis, Chicago, Kansas City, St. Louis. I mean, from that standpoint, kind of a similar story there. One positive dynamic that I can talk about is the amount of jobs. So the economy overall has roughly 6.2 million jobs more today than it did prior to the pandemic, 6.2 million more than 2020. At the same point, we know that there's a strong correlation to the growth in finance, professional and business services, and information. Those three segments have the highest correlation of office using tenants, of workers. So from that standpoint, we have 400,000 more jobs in finance. We have 1.5 million more in professional business services, and we have another 100,000 in information. So roughly the economy has, give or take, 2 million more jobs in the office space sector, in the areas that have the strongest correlation office, than they did prior to January 1st, 2020. So certainly there are some good news there. The other thing that I would say is that in my travels, I'm beginning to hear some folks that are opening offices, and day one, they are out of space, which is, not heard in the last several years. And I think that's, maybe an indication that our pendulum has swung so far that in essence, folks are cutting, they're being much more efficient with the design and programming of their space. And what they're realizing day one is that they need more space. So the pendulum may have swung too far, as it typically does in the commercial real estate industry. And from that standpoint, we may begin to see some anecdotes and some dynamics that indicate that to some degree, we've begun to hit or approach that apex. Certainly, there are lease rollover issues. I mean, you think about the average structure of a lease, 5, 7, 10-year terms. From that standpoint, we've basically run roughly 5 years from kind of the pre-pandemic from March 2020. So from that standpoint, I guess 4 and change. So we've got a little bit of time to go between that and 5 years. But certainly that role is probably going to decrease but it'll continue for the next 3 to 5 years. If we look at office supply, so I'm just looking at the growth in office supply. Again, I've taken, roughly 24 markets across the country to kind of give you just a little bit of flavor. But certainly, love to pick on the 6th district. There's nothing like picking on the home team here at the Atlanta Fed. But and those markets are highlighted in blue. You can look at Atlanta, and starting in 2008, roughly supply grew by less than 1%, 0.8%. Over time, 2006, 2007, growth was up 1.5%. 2008, 2009, because of the lag in construction, we started to see growth over 2, and then it fell off very dramatically to increase again and then begin to fall off. From that standpoint, you can see the likes of Austin, the likes of Miami, Nashville, and a few others that are seeing sizable upticks in the amount of supply. At the same point, there are a number of markets. Kansas City stands out from that standpoint. A few others where the amount of space is relatively muted. So, kind of to bring office to a close, we've got roughly 2 million more office jobs since 2020. Supply, depending on the market, overall minimal levels. But again, we know that sentiment is decidedly negative. Unfortunately, that's tapered by lease rollover. Users continue to anticipate weak future demand, and they continue to wring out a significant amount of space when their lease rolls over. Heard of a number of instances where tenants took 50 to 70% less space as their lease rolled over. My hope is that as we begin to hear anecdotes of offices that are opening and that have run out of space day one, then maybe we begin to see some of that efficiency ratcheting back. Just for the real nerds, I guess, which I'll put myself in that boat. You can do a little bit of light reading from our friends in the academic realm. I think it's fascinating. So, fully remote workers are 10 to 20% less productive than compared to being in the office full time pre-COVID. On the same point, there are a number of studies that show that hybrid workers are 3 to 13% more productive. And there are a number of studies there. So my view is that if you're a trivia night, I think we will end up at somewhere of this hybrid model when it comes to folks returning to the office. And from that standpoint, it's probably a 3 or 4 day a week dynamic. I think fully remote workers being less productive will certainly mitigate that. On the other hand, I think that the flexibility is certainly helping workers be more productive. And so from that standpoint, I don't see us quite reaching a full 5 days a week. As we transition to multifamily, again, I've gone with a national snapshot to give you context, but in essence, you can see some of those markets where we have talked for several years about population in migration, in essence, have seen very, very significant increases in vacancy rates. Orlando, Jacksonville, Atlanta, Dallas, Houston, Phoenix. Gosh, I could just go on forever. It seems like. So I think from that standpoint, we are beginning to see some challenges emerge in the multifamily space. Want to be clear, overall, there is a shortage of housing in the United States. At the same point, over the last several years, if you think about the feasibility of multifamily projects, we've not built a significant amount of workforce or affordable housing just because the feasibility has been very, very muted. From that standpoint, we've built significant amounts of luxury space, and now we're beginning to see this combination of more space, more units available, driven by supply, also driven by inaffordability. If we look at the change in the last year, so this is as of Q1 2024, we see a number of the markets across the US, the larger ones, again, seeing very, very sizable increases in vacancy rates. Certainly, we need to be, watching that closely. We know that there's a time where we'll see more maturities in debt. We know that there are a number of projects that have been constructed, and from that standpoint, as they reach stabilization or have reached stabilization, we know that they're not meeting their rates, and what it's taking to get to stabilization is taking longer. So the financials that were underwritten are not turning out. Let's talk about supply really quick, and a much different picture. Yes, we have a number of markets and a number of years where supply was muted, but then you look at kind of starting about 2014, and a number of our markets saw very, very strong increases in the amount of new supply. You can see the likes of Austin and Charlotte and Jacksonville, Florida, Nashville, Phoenix, Raleigh, Durham. From that standpoint, they've seen very, very sizable increases, and it's my expectation that those are probably some of the markets that are seeing their multifamily struggle the most. We've seen a number of markets where rent is down significantly compared to a year ago. Again, part of it driven by supply, part of it driven by the lack of affordability. Part of it also driven by just the amount of folks who are living at home. From that standpoint, you can see this heat map, the percent of 22 to 29-year-olds living alone, very, very challenged in the likes of Florida and Atlanta and Texas and California. Not so much here in Region 5, but certainly, I think you would characterize the United States as very, very, having a very, very small percentage of folks living alone in this cohort. What's interesting to me is the growth in the 25 to 34-year-old space. So in essence, you've seen those percentages grow very, very significantly on a percentage basis from 1960 to 2023. So again, potentially an untapped market, but I think it signals that affordability is a very, very significant issue at this point. If we look at retail vacancy rates, I could say that our friends in the press have helped us immensely with all of the rhetoric around the retail apocalypse. From that standpoint, developers, lenders, etc., all shied away from retail, and give it 10 or 15 years, in essence, the market is basically in equilibrium. From that standpoint, Region 5 and the neighbors, most of the markets here have and it's similar to the nation, very, very strong vacancy rates, very, very low vacancy rates. So some very, very positive news on that front. And really, well, unlike what we saw in the other couple of heat maps that showed change, in essence, a lot of markets that have declining vacancy from a year ago. So certainly some good news there. And industrial, another good omen for this market, for this segment, as vacancy rates are pretty low, but we're seeing a little bit more construction in some of the markets, and that's going to create some increases and created some increases last year. Talk about insurance. a big issue. Hearing very, very similar sentiment across the country right now. I guess the thing I should say is that Region 5 is blessed not to be on the coast. As I go to some coastal markets, I've heard of many, many anecdotes where their insurance premiums are up 200 or 300% in the last year. And that seems to be kind of a consistent dynamic. In some coastal markets, as a regulator, I'm looking into, whether the banks are making sure that those properties that they're lending on are, in essence, uh, right sized. They have the right amount of insurance. So I think from that standpoint, the challenges. If you look at kind of the senior, let me switch gears and talk about kind of lending while we're on there. A positive number represents a percent of institutions that are tightening their underwriting standards. Negative number represents that percent that are loosening, and net number loosening. So from that standpoint, as you can see in the last, give or take 2 years, most lenders are tightening their underwriting standards and have been tightening for a number of quarters. Many lenders are pulling back on their funding, in essence, re-entrenching with just their best customers. Part of that driven because asset values are softening. And certainly from that standpoint, we've come out of a time where, let's just use LTV, loan to value, was very conservative. I would argue that LTVs at most banks probably ranged 59, high 50s to low to mid 60%. However, with the change in value, which I'll talk about in a minute, I think that those LTVs have risen markedly. And so from that standpoint, it's my expectation that a number of our lenders are going to start having conversations about, in essence, the cash in refi. From that standpoint, they know that with the potential where value is potentially, from that standpoint, those LTVs are higher than they want them. And so from that standpoint, my expectation is as those loans mature, they're going to ask for cash in, or they're probably going to try to work with the borrower over some period of time to reduce those LTVs, in essence, getting more cash in. So Fed funds futures. Somebody may have thought that I was going to talk about interest rates, and I will. So this represents the target rate probabilities for the FOMC Fed funds rate as of December 2024. So at the end of this year, roughly six months from now. So we have this comes from the market. So these are not internal data. This is not internal data from the Fed, but this takes into account probabilities that market participants are assigning to Fed funds through the use of options. You can see I've taken a snapshot of those rates on 3 different dates: February 5th, April 10th, and May 4th. February 5th in orange, you can see that the expectation for Fed funds basically ran from 350 all the way up to 500 basically, with the strong averages at 400 to 425, roughly 35%, roughly 30% estimating that rates at the end of the year would be 425 to 450. Then we had some of the economic data indicating that inflation ran a bit too high, and that is what spurred us taking a reading on April 10th. And as you can see in light blue, those rates probability shifted markedly. So in essence, we have somewhere between 10 and 15% who are saying at the end of the year that rates will be at 525 to 550, which is where they are today. So there will be no rate cuts, according to this group. However, the two largest probabilities are 475 to 500 and 500 to 525. So essentially one or two declines. From that standpoint, we continue to watch the economic data. And then last, as of the time I put this presentation together 10 days ago, from that standpoint, we've seen a bit of a pullback as the May data, specifically the jobs data, was a bit softer than anticipated. And so from that standpoint, we see higher probabilities around two rate cuts around 475 to 500 or one rate cut 500 to 525 compared to the light blue bars, which were done on April 10th. So I think we continue to watch this as a data driven decision maker. And from that standpoint, I think we know, so far inflation has run at a rate that has exceeded expectations, whether that's market, whether that was the Fed, and we continue to watch that. Switching gears to cap rates. So this is the spread between the 10-year treasury and cap rates. And I like to look at it because certainly as you make an investment or advising investors in the marketplace, I'm asking the question, are owners or investors in the CRE space being adequately compensated for the risks that they're taking? My view is as these spreads compress, certainly the question grows larger. At the same point, as these spreads compress, my view is the potential for cap rates to grow increases significantly. So I think over time, we will begin to see, barring some change in the economic, the trajectory of the economy and the economic data that's coming out, it's my view that we'll have to watch cap rates as these spreads have compressed and compressed pretty markedly. One of the drivers of that is the upcoming wall of maturity. So as you can see, 2024, there's roughly $600 billion of all types of debt, whether that's bank debt, insurance companies, insurance company originated debt, government agency, or CMBS, CLO, structured debt. In essence, roughly 600 billion needs to be refinanced this year. My understanding is from talking to a number of folks on that front that really it's a transient extension, meaning roughly 12 months is being given right now. And so in essence, we may very well see over $1 trillion that needs to be refinanced into 2025 as you add 2024 to 2025 to get that number. Certainly, I think we see, that while it's not an insurmountable amount of financing that can be refinanced by banks, etc. I think as that amount grows, from that standpoint, I think we do need to watch. That does create more risk. Additionally, what we do with that, in essence, do we continue to work with borrowers as an industry? A number of lenders, are working under that assumption. That is what the regulatory community has said, that if a borrower is in good standing, that you need to try to work with them. In essence, but in essence, we know that some of the property, has been, significantly, has had significant value deteriorations, and it's hard not to pick up a paper these days and see some of those assets, whether it's the office building in St. Louis that sold for a few dollars a square foot, whether it's the largest office building in Fort Worth that sold for 90% less than what it was acquired for 3 years earlier, whether it's some of the New York, DC, or Chicago office buildings. From that standpoint, there are some buildings, some loans that are significantly challenged, and from that standpoint, I think we'll see some of that work its way through a different path. But it's my view that we'll see a lot of this continue to be extended for 12 months. One area that I would bring your attention to is that area shaded in orange. So in essence, the investor driven, the loans originated by the likes of private equity, hedge funds, etc. In a lot of instances, those loans had more risk associated with them. They had higher LTVs. Uh, from that standpoint, that group has kind of changed its MO and now views, debt not from, the lens of 7 or 8%, but, from 20%, in essence, waiting for there to be a distress situation and coming in and gobbling that up, acquiring it for pennies on the dollar. So I do wonder about the loans that have been made in orange. In essence, can they show up to a bank and be refinanced without a significant amount of equity put into the deal? I think that's an open question, but I think it's one that we have to think about going forward, because in essence, I think a lot of those loans had 70, 75, 80, maybe even 90% LTV. And we know that value has changed significantly. In essence, that LTV could be over one. And my expectation would be the lender would require cash into the deal to mitigate some of the risk. If we look at the change in value, um, again, I want to be clear. This is a national snapshot. As we know in commercial real estate, it's all about location, location, location. And so on that front, these are benchmarks, but it's influenced not only by the limited amount of transactions that have taken place, but in this case, we've added appraisals and done that because of the limited amount of transactions. And so you can see that in essence, value for apartments down about 8% in the last 12 months, and down, according to this index, roughly 28% from the peak that was probably late 2021, early 2022. So from that, again, this is a national index. I would expect, the property in some of the Region 5 markets to be holding up a little bit better. But from that standpoint, again, location, 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 we know that there are individual characteristics that also drive value. If we look at, the likes of malls, interestingly, that, malls are down roughly 1% in the last year, down 18% from the peak. Certainly, office buildings stand out very significantly. The results stand out very significantly in the fact that performance is down 16% in the last year and down 37% from the peak. And unfortunately, a number of those appraisals have crossed my desk, and from that standpoint, I can personally vouch that the values in some of these instances were down 60, 70% just because of the loss of tenants, or functional obsolescence is accelerating, or as we talked about, expenses are accelerating. I think we do have to be very cognizant of expenses right now, as they appear to be growing at a pretty good clip, in some instances growing faster than rents. So turbulence ahead in 2024. I think, unfortunately, the answer is yes. But part of it depends on the line of business that you're in. National economic growth remains resilient. Again, it's above where inflation is. And so from that standpoint, that will continue to impact Fed policy. I think the six state area, Region 5, health looks pretty good. Yes, we saw the slide where at the county level, where we saw, job growth down over the last year, but that was balanced out by the Philly Fed's coincident index. So those folks, while job growth may be down, They may be working more hours. They may be getting paid more. That's kind of my expectation there. A sizable amount of loan maturities are occurring in the environment where conditions are mixed. And we talked about, the challenges with office, starting to see more challenges in the multifamily space. At the same point, retail and industrial continue to hold up pretty well. Appraisal issues, honestly, I shouldn't give investment advice. I won't give investment advice. I'll be in trouble. But in essence, I think, one of the areas that CCIMs can help lenders with is there are huge challenges right now with accurately gauging what value is. Give you an example. Just within the past couple of months, office building in Miami, uh, three brokers went out to the building within 3 weeks, and you would know the names of these large brokerage companies. But in essence, the value that they came back on their opinion of value ranged from $8 million to $32 million. Same building, condition hadn't changed in 3 weeks. I'm scratching my head as well as the people who ordered the work. So I think that understanding what value is very challenged at the moment. There are significant issues with inaccurate values, and I think it's an area that professionals in the space can add value to lenders. I do think lenders in an environment like this, where there are some significant spreads, need to be aware of their risk management practices. And from that standpoint, these evolving conditions, as they're changing, the lenders need to see an evolution in their risk management practices. So on that front, Bert, I think I'm supposed to turn it back over to you, for 15 minutes of Stump the Regulator.
Yeah, sounds good, Brian. Appreciate it. Lots of data there, lots of good information. I've got some questions here, and for our audience, you can go into the Q&A function as well, and you can add your question. If you haven't sent them directly to me, you can send them in the chat or the Q&A function at the bottom of your screen. Couple right out of the gate, you mentioned, challenging time for appraisals. You mentioned cash in refinance. That's a term that I haven't heard very much in the last 5 years. That is not very friendly. So let's say I've got a deal, and I was hoping to do a cash out refinance at the time of my 5-year balloon, but if that's not in the cards, what if I don't have the money for the cash in? Do you think that banks are going to continue to do these little 1-year extensions, kind of extend and pretend? Or do you think they're going to say, move your loan, not our problem?
And I think there are, kind of too many variables for me to kind of accurately opine for. But what I would say, let's go to the kind of very base decision tree. In essence, hey, refinance or foreclose. Take those keys back. We know banks are not in the business of owning, operating real estate. From that standpoint, I've seen banks that have taken back real estate, and immediately they're saddled with 15 to 20% of that loan value in costs right away. So I think we're going to see an environment where it's not out of the realm of complete unrealism for banks to take things back. At the same point, my expectation is they're going to work very hard with the borrower to try to figure out a way, in essence, a win-win where, the borrower continues to operate the property and the bank continues to, receive its debt service. That's what I think the win-win dynamic is for institutions these days.
Okay, I appreciate it. Another question related to the Southeast. You mentioned the Southeast of the Sun Belt, that the not tenant, but just all delinquencies, consumer delinquencies, tenant delinquencies are on the rise. Do you think that the Southeast is going to struggle in the coming years? I know you're from the Atlanta Fed, so it's right near and dear to you. I went to a conference in Atlanta last year, and they said this is the place to be. But what do you think? I saw in your statistic that rents, vacancy rates are up. And I know we deal with a lot of syndicators that have had pro forma of rents going up. If vacancies are up, presumably rental rates will go down. How are people going to survive these deals, especially in multifamily, which has
Mhm.
had rising rates for, years and years?
Right. Part of it will be, how long ago did you take out that loan? But I agree 100%. I mean, being a regulator where I can go see what's going on, behind the black curtain at the banks, I would tell you that the results are similar to, what's public as far as CEO, Series CLO, collateralized loan obligations. I mean, in essence, you go to Series CLO with, a plan to buy a piece of property and reposition it, not unlike a lot of the construction loans at the banks. And from that standpoint, because of too much supply, because of issues with affordability in the multifamily space, we've seen those rent growth numbers that were penciled in a year and a half ago that have not materialized. We're seeing absorption slowing. We're also seeing, unfortunately, the likes of property taxes and insurance, labor, utilities, all those dynamics, while I think they're slowing just a hair, have been growing at very, very sizable rates. So that's impacting, the bottom line quite significantly. So from that standpoint, I think that, there's a story with the Southeast. Hey, there's a lot of population in migration. At the same point, we're low barrier, generally a low barrier to entry marketplace, meaning that you can go pull a permit very quickly and start, throwing up a building. At the same point, I think we're going to have some challenges, for the foreseeable future in the likes of office space, the likes of multifamily, and it will differentiate itself from the likes of the markets generally in Region 5 because there haven't been this wave of oversupply.
No, great points. I think, yeah, we see that here in the Kansas City market that we haven't been overbuilt to some of these suburban areas. I'm curious, just macro level Region 5, that your comments about, vacancy rates being up and rental rates possibly coming down. Is that going to be the same for all classes of property? I mean, not just asset classes like, office to retail to multifamily, but say multifamily, we're staying on that topic. Are those trends more painful for Class A, or are they more painful for Class C, or just kind of across the board?
Right. Well, I have to say, for we don't have the likes of y'all in Kansas City where you've got Taylor Swift coming to all the football games. I mean, think about the dynamics there. Certainly, we might trade that for a good portion of our in migration. But I think to your question, I think there are some challenges. Office space, multifamily over the next foreseeable future. Same point, retail, very well positioned. I mean, equilibrium looks. I mean, the amount of new deliveries versus absorption within a couple of million square feet nationally. So I think we would say, gosh, that's an equilibrium. Rates are up about 3% nationally on average in the last year. I think that area is going to do well. But back up 10 years, it was very painful. The folks engaged in the industry at that time, were looking around and saying, "Gosh, can't we be like industrial or multifamily?"
Right.
So I think there's been a shift, and there always is a shift. We figure out whether it's technology enables us to work differently, to buy products differently, to be more efficient. Technology certainly is shifting the way we use commercial real estate. So my expectation is, we continue to do that. I mean, think about, we'll bring it back to a Swifty example, but Airbnb. You think about, used to be without that, the hotels had to shoulder the influx of a major event, and now it's like everybody, will rent a room or your house or whatever, and so you don't see you don't see the hotels because of that technology shouldering that influx of folks.
Okay, interesting. Uh, Question about big cities versus more tertiary markets. I mean, obviously in the larger cities, the Kansas Cities, the Denvers, the Des Moines, St. Louis, kind of in our regions, they're going to have the bigger office complexes. But with the shift to work from home or remote work or hybrid work, that's obviously impacting the offices across the board. Do you think that the larger cities are going to be over the next, medium term, 1 to 5 years, are they going to be more negatively impacted through inflation and post-COVID environment, or is it the secondary or tertiary markets that are more impacted?
So I think the markets that are more impacted are going to be the larger cities, the areas where they're high density, urban concentrations of office space. I think that the question is fundamentally different in the smaller markets. As the average tenant size um, uh, declines, in essence, the decision dynamics change. I mean, you think about Denver, Kansas City, etc. A lot of those tenants have multiple floors. Like you can compress 20%, 30%, 50%, and not even change the address. Whereas if you're in some of those smaller cities, if you've got an average tenant size of 3 or 4 thousand feet, is it financial? Are you financially incentivized to say, "Gosh, I'm going to cut 15 or 20% of my space, 600 feet or 800 feet"? I'm not sure that the decision is the same. And from that standpoint, I think tenants will probably shy away from that in the smaller markets, whereas ringing out floors of office space, probably the financial incentive is there.
Okay. Yeah, makes sense. Okay, looking at the Q&A, I don't know that we have, oh, here we got another question just came in. When you mentioned office vacancies in large dense markets, you did not allude to the crime and safety issue. Is the Fed aware of this problems? How much is that impacting valuation or occupancy?
Right. I mean, if you think about safety and crime, that's a settlement issue, and we know that there's a shortage of workers right now. From that standpoint, if you can't get the workers that you want, I think folks are going to move their space. And so on that front, I think municipalities are going to have to do more to ensure the safety of workers in those areas. I think you could see self-taxing districts rise more. That way, they have more control over security and some of those services that the municipality typically provides. I think one of the challenges that we will face, especially as office building values drop, is going to be a decline in tax revenue. It will be offset to a degree by residential home values continuing to rise. But if something, if resi runs into some headwinds, then there's going to be a sizable problem. But in essence, I think that because of the decline in some of the tax base, the municipalities will try to offload the responsibility of some of the basic services that they typically provide. And from that standpoint, you may have to band together with your neighbor and create, in high density areas, you may have to create, self-taxing districts. And in that essence, you can control security. I'll give a good example is Midtown Atlanta. We have the Midtown Improvement District. From that standpoint, we have Midtown Blue, which in essence is a bunch of off-duty police officers. We have security vehicles, et cetera, for them. And what they can do is they're empowered to, hold people until, Atlanta PD gets there. Folks are not doing what they should be doing. And we can, Midtown can detain them until the police get there and sort things out. From that standpoint, I do have questions. Do those self-taxing districts create, in essence, an advantage over areas that are not able to create self-taxing districts? If you can influence the settlement, if you can mitigate crime, in essence, increasing safety and that positive perception. Businesses, tenants, workers are going to want to go to those. Shoppers are going to want to go to those areas, and they'll shy away from others. So I think real estate performance will outstrip in those areas compared to other areas that don't have that.
Yeah, Brian, I'm familiar with that here in Kansas City. We have those community improvement districts as well. Sometimes the personnel are merely street sweepers, not police or security guards, but they create a presence. I'm curious, to follow up on that question, how does a city turn the tide against it when it starts to unravel? I think about St. Louis recently was in the national news for having one of the most vacant downtowns post-COVID. And I think one of the largest or second largest building in the city just sold for $4 million. I think it was
Yep.
100 million or 200 million in the last decade. So obviously that's a negative trend. Just putting more security guards, police cars are not going to fix it immediately. How do they get over the hump on something like that?
Right, and you need a not only do you need daytime residents, workers, shoppers, but you need to work very hard to make it 24/7. So you need to bring in the folks who will live there at night. So I think from that standpoint, there's a multi-pronged strategy to get some of those synergies up and running. It takes a little bit of time. I think we're going to find out. It's a very astute observation. I think we're going to see, uh, I'll pick on downtown Atlanta, which is right next to Midtown, it's just immediately south. You know, I'm not sure how many folks, spend significant amount of time in downtown Atlanta. It's a very high concentrated office space market. From that standpoint, I think there are people there during the day, but not at night. And from that standpoint, you contrast that with Midtown, where it's more of a 24/7 vibe. There are office buildings, there are also restaurants, there are all parks and all kinds of other dynamics. So I think you have to have a multi-pronged strategy if you're a municipality to get folks back into some of those areas. And as we know in our business, you're going to have to pick businesses that you think can contribute to that community.
Okay. We got time for one or two more questions. One more just came in. Thoughts on the Bureau of Labor Statistics manipulating data or changing its data, specifically removing coffee, canned tomatoes, etc., from the April CPI report that's expected to be released tomorrow. With these costs skyrocketing, why remove these from the CPI factors?
To be candid, I'm not aware of that. So I, would not want to venture an answer.
Fair enough. How often do they change the variables within the CPI report?
I mean, they have to publish their changes in advance. So I don't know. I'm not aware of like how often they do changes, but I think they know that changes are challenging at best. So I don't recall them changing very often. But I don't have an exact answer.
Okay. All right, Brian. Well, it's just after 3 o'clock Central Time. So thanks again for sharing with us today. Thanks for your expertise on this webinar. For all those that attended, thank you. Also, just a reminder, if you registered, you're going to get an email copy of the recording and the slides. Also, thanks again to our sponsors. If you're not already a member of CCIM or a participant in this course, you can go ahead and take a moment to sign up for our e-newsletter at ccim.com. And someone just asked real briefly, can I get a list of the questions? I don't know that the questions are in email form. I don't know if I can get them out. You have the recording. I can see if we can, I'll make a note here to see if we can get them emailed out with it as well. But again, sign up at CCIM. More webinars that are free coming up. And everybody, thanks and have a great day.
Thank you.
Thanks.